Okay, what's up, guys? Welcome to the podcast today. My name's Carson, and we have two great guests. Kaiden from my work.
I'm Kaiden Hansen from Carson's Work, director of RIP. And then we have Carl with us. Carl, what's your last name?
Grimmett.
Carl Grimmett, the tax master.
Carl Grimmett, do you go by tax master, wizard, genius? What's like your preferred title?
My preferred pronoun. I don't know. Maybe strategist and tactician as far as that goes, as far as planning goes.
Okay,
cool.
Who are like your typical clients that you work with? We have a lot of people that will be listening that are making a substantial amount of money or will be, and want to figure out what to do with that money, right? Our big focus here at the company is we try to help people make as much money as possible. That's where Kaiden, myself, and others, we come in and we help people make as much money as possible, and we want to teach them and educate them by experts, right?
Right.
How do you then take that and transition into something that is passive? How do we, and a lot of this has to start with the taxes, right? That's the base.
Taxes is a big component of that.
Right.
I think coming from the mentor aspect, I think that's great that you're offering this education to your team members. And my typical client, I do have a large amount of door-to-door sales guys. I've been taking care of door-to-door sales guys for 12, 13 years. And I could go through that history, but I do have other clients, but real estate investors and a large client base. But one of the things about passive income, which I'm sure there's maybe a myth and maybe not, but passive income means you don't have to work for it, right?
Right.
But it is true that it can be a lot less work than, especially going door to door, knocking doors, and putting forth all that physical labor. But the one important thing that my sales guys have going for them is that they have cash flow. A lot of operating businesses, they can, at the end of kind of their career, they can sell their business because it has these operations. But if you stop doing it, your cash flow stops, right?
Right.
So your cash flow is your working asset. And to be able to put that cash to work for you that's what you want to do. There's many passive investments. Real estate by nature is a passive investment.
Is real estate the biggest? So you said tax strategist is what you like to be called, right? So let's say someone makes 200 grand, 300 grand, 400 grand, right? Or maybe it's 100 grand. Right. What are you typically helping people to strategize for? So you help them strategize with their taxes. Then what do you help them strategize to invest in? What's the typical investment that you have them do, or that they will do, and you'll help them strategize for?
Well, it does vary based on a person's situation.
Yeah.
So the higher your income level, the more, I would say, opportunities for tax strategies there are for you, just plain and simple. That being said, I like to come down to kind of the root of things, and I really express to my clients that being organized and capturing all their expenses is kind of day one, number one thing to do. We overestimate what we make and we underestimate what we spend.
Yeah.
So if you're not tracking all those expenses, you're paying more tax right off the bat.
Right.
If you're in the top tax rate, 37% federal, and depending on your state, anywhere from 5 to 13%, that's a dollar that you don't have as an expense is basically 50 cents that you lose out on as a deduction.
It's crazy.
So, depending on my client's goals, is really what really kind of guides the planning. You can use a 401k vehicle to defer some taxes, up to $57,000 a year in taxable income. Then obviously when it's in there, you have to decide where you want to invest. There are real estate investment options there. Real estate investment stocks and other vehicles within that 401k. As far as owning your own real estate or getting involved in some venture capital funds or private equity. It depends on, it really depends on that specific investment.
Yeah.
In general, the benefits of real estate is you're typically going to get, an appreciation aspect to this asset, as well as a cash flow aspect. And as far as where the taxes come in, it's basically called a passive activity because, one, you're not actively participating in it per se,
Right.
and passive activities have actual special rules attached to passive activities. You're unable to actually take passive losses against ordinary operating income. You have to actually match that with passive income.
What's a passive loss?
So a passive loss would be you buy a rental property, you have a mortgage on it, you're paying the mortgage and expenses, you collect rent, and you end up with a net loss. You have
On cash flow.
on cash flow and on paper because you're going to add depreciation,
Okay.
Which is an accounting function.
Yeah.
On that, so you might have a $10,000 loss.
Yeah.
Now, if your taxable income is less than $150,000 a year, you can actually take up to $25,000 of those real estate losses against your ordinary income. However, as probably a lot of your sales team are going to end up making more than that, but kind of the beauty of that is that you don't lose those losses. They carry forward. They get released when you have other passive income. So say that you have, you're a silent investor in another company that's passive. You actually have a property that's cash flowing and on paper making money. It'll actually match against that income and reduce it. So it's kind of a loss savings account going forward. Now, if you sell that property, you can actually take any losses that are with that property as well. So say that you have a $50,000 accumulated loss and you sell it. Say that investment just ends up being not a good one, right? And you end up taking a loss on it. You can take all those losses on that year of disposal and match that against your ordinary income.
Okay.
So how that can kind of look year after year investing in real estate is that usually your initial kind of 5 to 6 to 7 years of, say, a single family residence will show a loss, will show a paper loss because of your depreciation, assuming you have a mortgage on it, taxes, those kind of things.
Can you explain to everyone listening, how, break down me buying a property and what is depreciation and what does that do?
Okay. So I'm going to take a single family home as an example. So that property has a building on it and it has some land, right?
Yeah.
And typically in a typical single family residence, about 20% is land value and 80% is building.
Yeah.
So land you cannot depreciate.
Okay.
But the building, and just think about if someone's living there, the actual building is going to be deteriorating over time.
Okay. That's why you can depreciate.
Yeah. So
And that's why land doesn't depreciate.
right. Because
Okay.
it's going to be there, and typically it's an appreciating.
It's going up in
asset.
value.
So
Okay.
So depreciation is purely a tax function,
Right.
Although it is related to the life of that asset. And I'm using quotations saying that, right? You take a portion of the value of that each year, in addition to your other expenses. So if you have HOA, if you have utilities you're paying, your mortgage interest, property taxes, any repairs, those kind of things. So each year you account for the gross rents received and all those expenses. And in the first few years, typically if you didn't put a whole bunch of money down, is going to have a loss. But over time, those rents are going to go up. That you may refinance that mortgage, and that mortgage payment might drop, and the interest might drop, or you might pay it off.
Yeah.
And so over time, that property is going to be netting taxable income. So if you're adding new properties each year, you're going to have excess losses to mitigate that. So you can, go decades without ever paying tax on these real estate investments while these renters are paying your loan down, and you're getting appreciation, which is not realized until you sell it. So you have this appreciation over time.
Yeah.
Now, there's what's called a 1031 exchange, which is, like kind asset for a like kind asset. So
sell a property, take the appreciation, put it into a new one.
Yeah. So you basically
no taxes.
Basically, you defer that gain.
Cool.
And actually, technically, you can defer it until you die and get a step up in basis and never pay any tax on it.
So I actually had a question for you that I thought about. I was at this thing, and there was a guy that took I don't know if it was an accounting class, an economics class, or something like that. I don't know if you know the answer to this, but he was saying that because we want to know about 1099s and W-2s, right? You're probably the guy for that.
Yeah.
But is it true that before either World War I or World War II, the United States, like when was the conception of W-2? Do you know that? And then was the government actually self-sustainable?
In what aspect?
At a certain point?
As far as collecting
taxes.
And having a balanced budget?
I heard that was true before either World War I or World War II, and then they sent everyone off to war, and then they said, hey, you know what? We're just going to take a certain amount out of your checks, and then...
Yeah,
it never changed back.
Right.
Or
most of that's kind of... So before 1913, essentially, there was excise taxes, though.
What's that?
So, there was like the sin tax, which is alcohol, tobacco.
Okay.
Excise taxes on whatever commodity. The British put a tax on tea, those kind of things. So in early America, it typically was an excise tax, basically on the sale of some good. And the income tax didn't really come into play till 1913, which was basically around World War I, right? So, and the top tax rate was 7% if you made over 500K. Between 0 and 20,000 was like 1%. So,
holy freaking crap!
In 1913, basically, it was like 1%. But in 1944,
could you imagine 1% tax right now?
Yeah, I mean,
holy crap!
But in 44 and 45, the top
1944,
tax rate was 94%. So that's World War II.
Wait. So it went from 1% to like 94%.
Yeah. So, I mean, and this is progressive, right? So I'm not sure what the bottom tax rate was at that time.
Okay.
But so we have a progressive
That's the top
tax rate. So,
okay.
That was
so you're saying the bottom tax rate in 1913, or is that just across the board?
The bottom tax rate in 1913 was 1%.
Okay.
If you made up to 20,000, then it was like 2 between 20 and 40.
What happened within those 30 years? Yeah.
So it's always kind of crept up. And then it has, actually, in 44, it was top at 94%. So if you made over $1 million, you were 94%. I mean,
you're paying $940,000.
Yeah.
Have you ever read Atlas Shrugged?
Yeah. Mm-hmm.
I'm reading that right now. Yeah. And that's like blowing my mind because
it's like what's the point?
Have you heard of the book?
I'm reading it right now. I just started it, but I haven't.
What's up, dude?
Dude, I read a little.
Yeah.
Because
it's interesting.
What really sparked my interest on reading the book was that in the book Atlas Shrugged is this guy Atlas represents like the producers of the world, right?
Right.
And they're the Amazon, Jeff Bezos, Elon Musk. They're the ones that like are progressing the world forward, and they're like holding it. Atlas represents them, right?
Right.
Holding the world on his shoulders, and then as all these looters and consumers and just all these different people of the world, they keep pushing at Atlas and putting him at a 94% tax rate, for example. Like if Elon Musk is taxed at 94%, like at some point he's going to be like, how much is this worth it?
Yeah,
right.
I mean,
maybe not Elon, but
the majority, labor of love, right? I mean, there's no financial incentive,
right? Like the majority of there should be so much more incentive for entrepreneurs to push and innovate the world, versus like in this book, it just talks about how government or society or people are just pushing to tax the rich and make it so we actually spread the love, when in reality, like if you take all the money in the world, spread it across every human being, I think it was Warren Buffett that had this quote, spread across every human being in the entire world, in 10 years, it would end up back in the exact same pockets.
Right.
All habits.
Yeah. That's a systemic, political, economic. It is really, it can be looked at in so many ways and aspects. But I agree. When you take away the financial incentive, how do you grow? How do you innovate if you don't have that financial incentive?
So here we are now. What are the tax brackets today?
Today, the top tax bracket is 37%.
Okay.
And that's taxable income above 450.
450.
About 450.
Okay.
Now, capital gains rates, which is more applicable to investment type activities.
Which means I have stock, it goes up in value, I sell it. That's capital gains.
That's capital gains.
Right.
Or it could
My profit.
Or you could buy a business. You could operate a business and then sell your business to someone.
Capital gains is also on real estate, right? The appreciation of real estate.
Yes.
If I don't 1031 exchange into another property.
Correct.
And defer that to the time that I then sell all of that real estate.
Right.
Correct.
And there's some details with that, but long-term capital gain is afforded to an asset that you've purchased and owned for a year and 1 day. So please don't sell it a year because you'll pay short-term, which is ordinary rates.
Can you actually explain that?
Well, yeah. So, it's just longer than a year. So
longer than a year, what's the difference between before?
That is a year and a day. So long-term capital gains is preferential treatment, 0, 15, or 20% federal tax rate. Short-term capital gain is still a capital gain not subject to self-employment tax. So there's a difference between that, but it's at ordinary rates. So if you're in the 37% bracket, it's taxed at 37%.
So based on your income is what you're taxed at for capital gains.
If it's short-term.
If it's short-term.
Yeah,
if it's
you're gonna
within,
hit that
if it's
bracket.
365 days. If it's 366 days.
Then you're the preferential treatment, which is, again, still based on, a calculation is based on your other income, but the top capital gain rate is 20%. So it does not go any higher than that, but typically it's about 15%.
That's based on when you acquired the asset.
Yeah, when you acquire the asset.
When you acquire the asset to then when you sell it.
Yeah, correct.
And that functions for real estate, stock, everything.
Yeah, typically just about everything. Stock options can have some additional kind of criteria with that, but yeah, generally.
What about crypto?
So crypto is same thing. So, and in fact, crypto is considered an asset. And in fact, if you're trading a crypto coin for another crypto coin, that's actually deemed a sale. So any conversion to another crypto coin or an outright sale, it doesn't have to go to fiat. It can be just a crypto to crypto.
Okay.
So any sell transactions. So holding those year and a day, which with the volatility sometimes does not make any sense. You just, got to trade it when you trade it. But
if Kaiden bought Bitcoin at, let's say, $56,000, and he's now selling it right now at, what are we at? We're below 20, I believe, right now. Let me check here. So my question is.
So that is an interesting point about capital losses.
Yeah. So we're at 21,000 right now. We did get down to. So let's say Kaiden bought at 56,000, sold at 19,000, and rebought.
So
what's the regulation there right now?
So you're probably referring to a wash sale, right?
Yeah.
And in the stock market, if that occurred, you would not be able to take that loss.
In stocks,
bonds, futures. Futures typically wouldn't be a long term anyway. But with crypto, that rule does not apply. So you can essentially harvest a loss by doing that.
Yeah, right. Right now you can.
Gains, right? Right now you can. There's talk about making that wash sale rule apply to Bitcoin, but
heard that.
It's not law yet. Who knows? But I could see why they would do that.
So anyone that has crypto right now, pretty much any kind of crypto should sell it right now. It would be intelligent
So here's the flip side to that, though. If you have capital loss, whether it's short term or long term, you can only take $3,000 of that loss to match other income losses. So if you have W-2 income, if you have other business income, you can only take $3,000 of that capital loss per year, up to 20 years it carries forward. You can match it against other capital gains. So if you have other short-term capital gains, if you have, you sold some real estate, cashed out sold some stock, you can match capital losses against capital gains. But if you don't have any other capital gains to match, you can only take $3,000.
So it has to be capital gains. If not, like if I'm a 1099, I'm looking for, let's just say like write-offs. Mm-hmm. And I bought Bitcoin at 56 grand and I sold it at 24 grand.
Right.
And then rebought, I can only claim $3,000. And that's if I have other capital gains.
You would realize that loss. But as far as how it works out on your return is that you'd be able to realize 3,000 of that. And then
unless if I have more capital gains.
Yeah. And then if you had capital gains that year, you would match again. So
is it 3 per year?
Yeah, 3,000 per year.
So that's a $30,000 loss that I just took, right?
So you got 10 years to be able to. I got
10 years to actually claim. So
yeah.
Okay. That's pretty cool.
But that's how, usually if you have an investment advisor and you have mutual funds and stocks and bonds, typically they will be harvesting losses to offset the gains in your portfolio.
Solid.
And so they will, they have to still contend with the wash rule, but they will basically sell off and maybe buy something not so similar so that they aren't subject to the wash rule, so that they can mitigate some of those capital gains.
But if I'm in the stock game, I probably want to be in the crypto game for the wash rule to offset the capital gains of the stock.
If you have some gains.
It's true.
So
I have no gains. I'm also not in the stock market, really.
Yeah,
if I were to be.
But if you have some pretty healthy crypto losses, I don't see it hurting you to even have those losses carrying forward, because you kind of have some losses in the bank.
Totally.
And if you can simply sell and rebuy.
Yeah.
Especially if there's not a new rule in place, then it can make sense for planning. And in planning, there's the kind of on paper strategies. There's your goals, your cash usage that best aligns with your goals, and then there's also the economic outlook, the current economics, what laws may or may not come into play. So there's a lot that goes into tax planning, and a really solid professional takes that into account.
Okay.
Tax estimating is one thing where, we create a mock return and kind of basically just do an estimate on what you're going to owe for tax. But going beyond the estimate and actually tax planning involves quite a bit more. Now, it may only involve a couple things that year, or it may involve many things, or we may plan to start doing something next year, or there could be some timing planning items that come into play. So it's pretty dynamic.
So, question on W-2 versus 1099. Like, I've always just done my thing. Like when I was a kid, I washed garbage cans, and like I could never get a job once I started washing garbage cans. So my dad, he lent me and my brother a pressure washer, and we'd wash garbage cans, and we'd charge $10 a can. So I do that, and I'm like, dude, I can't be a lifeguard. I can't scorekeep. I can't do any of this stuff where like I bet that was W-2. It was great money. Yeah. I think we were 14, 15, something like that, and did 100 garbage cans in a day. Like that was the goal. So 14 or 15 made $1,000. It's pretty sweet. So
that's awesome.
But then it was like, well, like I can't really justify going and working like as a lifeguard or whatever. It just doesn't really make sense. And so, like the whole idea of a W-2, like there's two perspectives. We have like, I want to be an entrepreneur or an intrapreneur within a company where I feel like I can be creative, innovative. I can grow. I can be an entrepreneur, but without a lot of the risk. Right. There's company backing with that. And then you have like, what's like the difference in taxes between a W-2 and a 1099? Like, is it more beneficial to be W-2, more beneficial to be 1099? Selling solar, like what's more beneficial, W-2 or 1099?
That is I've had that question, hundreds of times.
Yeah.
And it's not so simple to answer, but I will give you kind of the breakdown of the differences and where one can make sense over the other. So you asked a question about, when the W-2 came into play.
Yeah.
It was actually like 1944. And I had to look this up because I was like, I've always seen it, right? But because we had individual income tax rates, right? So we were being taxed on our earned income, right? At this point, after 1913, we were taxed on our income. Before it was transactional based taxes, excise taxes, right? Well, back in 37, they started Social Security tax, right? And it started out at 1% on your first $3,000, okay? And it wasn't until 51 where it was applicable to self-employed people. Now, before that, you weren't subject to it, but you also didn't qualify for Social Security benefits either.
Right.
So in 51, they said, no.
Do self-employeds qualify for Social Security?
Yeah, if you pay. So we'll get to that in just a minute. But yes, if you pay, it's 40 quarters is how you essentially 10 years worth of paying into the Social Security system is how you qualify.
Okay.
So being a W-2 versus self-employed. So income, federal and state taxes are identical, whether you're W-2 or self-employed. Basically, your income tax is the same.
Yeah.
Social Security and Medicare taxes are what, if you've had a W-2, you see FICA tax and there's some taxes taken out of your check. Now that's 7.65% of your income. Self-employed pays double. And the reason for that is your employer is matching that 7.65% on the back end. So if you get paid, $10,000 a year, you're paying $7,650 in FICA tax, but your employer is paying you $100 plus the other $7,650. Now, if you're self-employed, you're responsible for both sides of that. So 15.3%. So if you're reporting your income, your self-employed income on Schedule C, your income less expenses, whatever that net business income is on your Schedule C reported on your individual return is subject to that 15.3%. Now, some of the benefits of why you'd want to be employed comes down to the benefits that employer offers, right? I mean, you did mention, they offer maybe training and the equipment and all those things to develop yourself and, come in, do your job, you leave, you get a paycheck. You don't have any inherent financial risk associated with that, right? If you are offered health insurance or 401k benefits, or they match your 401k, or they're paying for disability, or they're funding an HSA account. So all of those kind of benefits add up as far as total compensation.
Yeah.
So a lot of people look at their compensation just as their salary, but there's a lot more to what that company is paying.
That makes sense.
Now, if you are incurring a lot of costs that your employer is not providing and not reimbursing you for, that's where a 1099 can really make a lot of sense. Because if you're driving your vehicle and there's no reimbursement for that, you have wear and tear on your vehicle. If you're self-marketing, self-promoting, that also is a big expense that you cannot take. And so when you look at a 1099, you may give up some of the benefits the employer is offering, but you're able to deduct a bunch of expenses that you're incurring, which ends up lowering your taxable income overall. So a lot of people utilize the S Corp strategy because an S Corp, the income that comes from an S Corp is not subject to self-employment tax like it is on Schedule C. However, you do have to pay an officer a reasonable salary, which is filed on a W-2 and subject to self-employment tax. So when you have an S Corp, you you have to pay the officer, typically a single owner, that would be you, right? You or I. And so you can manage, because in the S Corp, you have an employee aspect and then you have an investment owner aspect. And that's why you can pay a reasonable salary to operate that and then have a part of that income that is not subject to self-employment tax. So when I've been asked this in general, it comes down to those factors. When I look at it specifically with a specific situation, I mean, I have to lay it all out and just look and nitpick every expense. But generally, if your employer is not offering a whole lot of additional benefits, likely that 1099 self-employed, being able to deduct your expenses will end up benefiting you in the long term, and even from year to year.
Yeah. So I have a question with, and we can kind of wrap up with this. Like, if in just like a perfect situation, I'm a 1099 employee or 1099 self-employed, right? I probably want to set up an S Corp, right? Pay myself as a W-2, or have an accountant help me pay myself as a W-2. Right.
You do have to file a W-2, and there's payroll filings behind the scenes on that. They're due quarterly and
I'm not going to do
that.
Yeah.
So, I mean,
no one does that.
And why would you? I mean, really, you should be doing what you do best.
Right.
And my clients that do planning with me and that utilize the S Corp structure properly, those details are covered as kind of a cost of doing business. But again, it's a deductible expense, as well as, before the end of the year, we determine what tax planning strategies are going to work best for you.
Yeah.
And often my clients, I mean, I would say a lot of them don't ever pay me a dime, just with the tax savings from planning and those kind of things. So
I love that. I think a lot of guys look at paying a CPA as a major expense, but in the end, like, the savings that a tax planner is going to bring is way worth it. If someone wanted to get in contact with you, Carl, what would you recommend, or what would you recommend they bring to the table to start the tax planning process? Like, what do they need to do? Because, like you said, you do want them to play to their strengths. You want people to do the things that they're best at and have you worry about the taxes. But what is their role in the process?
Yeah. How much work is required?
Yeah. So, I mean, on a basic level, keeping your own records, income and expenses. We provide, a tax organizer, or we can set up QuickBooks and do your bookkeeping.
Like for me,
higher cost for that.
Yeah.
But as far as the peace of mind knowing everything's dialed in and the records are up to date, for some people kind of starting out, oftentimes they just will use Excel, or once a month kind of add up the receipts. I have an organizer that I've developed over a decade that aligns with my sales guys that is pretty self-explanatory and describes the expenses that are deductible.
I feel like it makes no sense for someone not to hire someone to be a bookkeeper, at least in the sales space. Like, the time that you would spend trying to do that, unless if maybe you're Chandler and you're probably already doing it just to know. Like, it doesn't really make sense. Like, if you can, like, over the amount of time that you're going to do that over the course of an entire calendar year, you're probably going to save that amount of money if you eliminate that and make one extra sale.
And just so all the
in
listeners,
solar, literally one extra sale pays for the entire thing.
For bookkeeping, for sure. Just so everyone knows what bookkeeping is, like what Carson's talking about is keeping your receipts, keeping track of all of your expenses and all the things categorizing it, following that credit card.
You're talking about marketing expenses, things like that. Like, what are those?
It's a lot of work.
And how we do it, QuickBooks has a QuickBooks online program. It's cloud-based. We connect it to your bank accounts and credit cards, and we download those transactions and put them in the correct categories. And, honestly, if you're going to be an investor, whether it's real estate or other investments, and you need financing, and you will, the banks want to see profit and loss. They want to see a balance sheet.
Yeah.
It's year-to-date current right then and there.
And they'll take your last year tax return, and then they want your current year-to-date profit and loss. And by having it up to date on a monthly basis, you're set. You can have that stuff sent over immediately to that bank.
So that was my last question that I wanted to wrap up. You have 1099, right? Self-employed.
Mm-hmm.
They want to get into real estate, right? Trying to actually build long-lasting wealth, right? Get the cash flow. Mm-hmm. And I love that you brought up the passive income, and because it's really become like almost like this hot word,
right,
that is very affiliated with like get rich quick as well. Like online, get rich quick, passive income. Like you never have to work anymore. You can travel, work from your laptop, whatever.
Right.
It doesn't really make sense. Whereas cash flow is minimizing work that you're doing, work in the areas in which you're really good at that makes you the most money, and put it into things that make your money work for you.
Right.
And you're still going to do minimal work, but you are growing your money at a higher rate than a 0.04% growth at the bank, which is getting dominated by inflation anyways, because inflation, not 9%. You're not outweighing 0.04%. Right. That. So 1099, I want to get into real estate. What's the fastest way for me to do that? How do I do that? Let's say I started my 1099 career this year. What do I do?
Wow. That's as far as how you start investing in real estate. There's so many different avenues. Honestly,
or how do I prep tax wise for that?
What I think, when I talked about organizing and kind of budgeting to where where you need your money to be to cover your living expenses, what you do, and basically have a plan for how much you are going to have excess and be able to invest per year.
Right.
Because real estate investing really is kind of a long-term play. Right?
Totally, for sure. That's a real retirement plan in my eyes.
Yeah, it builds. So, I would say the majority of my really wealthy clients, a large part of that is from real estate, if not the majority of it.
Yeah, 401k, IRA are getting absolutely obliterated by real estate.
Yeah, and we're coming into an interesting time right now where property values are starting to fall,
for sure,
and the inflation, the raise of the interest rates, putting pressure on prices. But if you are renting a place, that appreciation, you can sit on that and have it rented out for years and have that appreciation come back. Deciding or defining for yourself if you want to own a property and rent it out and manage it yourself, or if you're going to pay a property manager a big chunk of that revenue, it's going to take longer for you to build wealth that way.
For sure.
Or get involved with a mentor group or a local real estate investment club is also a great way.
Yeah.
And really, with your industry, I know that there's people around that.
I think the hardest thing isn't the money. It's not like, I think a lot of guys need to know, like, hey, how do I figure out, like, what is my criteria? Like, how do I know if this is a good deal or not? Which, like, we can help teach that. But like, how does a guy qualify for a loan? Like, let's say it's his first year as a 1099 employee or self-employed. How does he qualify for a mortgage?
Well,
via taxes.
Well, that's going to be in the first year. It's definitely going to be a challenge.
Yeah.
And typically, banks want to see 2-year tax returns from a business. Some will allow you to have kind of a full year financial and 1 year of a business tax return. And really, that's kind of up to the lender. But it is more difficult for someone self-employed to get financing than someone who has a W-2 with the same income.
Right.
Money down can help. Money down can definitely help with financing. You can. There's ways that you can be involved with properties as kind of a joint venture with someone until you kind of have your 2 years either created through a partnership or just an agreement.
So you find someone that has 2 years tax returns, partner with them, you guys go in on a property.
Right.
Okay,
Or
and
if you got
then
mom, dad, brother,
Yeah.
also.
so co-signer going to someone else, and then the other thing is once you hit that 2-year mark, it's way easier to qualify for
is.
mortgage, right?
And if you have increasing income or steady income, net income from the business, that's what they want to see. If you have decreasing, typically they'll go off the lowest income. They used to just go off the average. Now they're going off the lowest income. So, so the one balance there, we want to lower your taxable income to minimize your tax.
Right.
But the competing interest is you have to show enough to qualify for loans, right?
To qualify for the amount of
Right.
that you want.
Right. So
if I want an $800,000 house in Utah, which is almost average at this point,
yeah.
like, do you know how much I even need to claim?
No, I don't. I mean, I would imagine, a couple 100,000 for sure. So, I mean, so as far as depreciation, so say that you buy a vehicle and you're deducting that in your S Corp, and you accelerate that as a large depreciable deduction, the lender will actually add that back to your income in that year. So sometimes you can use equipment depreciation to lower your income,
Like a vehicle. How much does it need to weigh?
For over 6,000 pounds for an SUV or truck to take Section 179.
Okay. And what you actually told me is you don't have to buy it cash, right? You can finance it and
Correct.
claim. So I didn't know that. I thought you had to buy it cash.
Yeah, I know.
In order to claim the depreciation on that.
Right. So, I mean, if you're using a loan, you are buying it with a loan, and now you have a loan you have to pay off.
Right.
But yeah, you don't need to buy it cash. You can finance it, but you need to put that asset in service, right? So you need to have possession of it. It needs to be operating.
Right.
And so that's one of the ways that you can still maintain the income to qualify for loans, but yet not pay a whole bunch of tax.
Way cool.
So, and there's much more than that, but that is a good point. That is a good technique to utilize.
Carl, how do people find you? Are you on social media? How do people get in contact with you? Like Kaiden was saying, like, how do people get in contact with Carl to get set up for taxes?
Yeah, so our website, DrillDownSolution.com. You can go to our website.
Drill down solution or solutions?
Solution.
Okay.
Yeah, solutions was the domain was taken, so I had to drop the S. So
Okay. Are you on social media?
our business is it's on LinkedIn, and
Okay.
and then just our office number. Our client excellence coordinator can always set up a time. Our phone number is 801-225-8474, and she'll coordinate a call or coordinate a Zoom or a call or in-person meeting.
Cool. Awesome. And you're
in
50 states?
Yeah.
Okay.
Yeah.
Super
in fact,
awesome.
I'm kind of a multi-state filing specialist. So.
Cool. Awesome. Carl, thanks for coming on. Appreciate
Carl.
it.
Thanks for having me.
Kite Dog, thanks for coming on.
That was good, guys.